Real estate investing is one of the most lucrative ways to grow your wealth, and it can be an incredibly fun way to make money too. While there are many different strategies you can use, such as flipping houses or wholesaling homes, this list focuses on the top 5 most profitable real estate investing strategies in 2022. All of these real estate investment strategies have been tried and tested by experts, and they have all been proven to yield high returns on investment year after year. Watch this video all the way through so you don't miss anything. Hello everyone, welcome back to Fascinating Self. Now let's get started. Method number 1, buy a rental property. Purchasing homes and renting them out is a great way to produce extra monthly cash flow. To do this, you have to purchase a house that has a combined monthly mortgage payment, home insurance payment, and property tax payment lower than the rent the property commands. There are several ways to do this, from buying in an area with high rents to putting a lot of money down so that your mortgage payment is low. The best ways to do this online is with Roofstock. You can buy single-family rental properties that already have tenants and cash flow easily online. However, there are 2 downsides to owning a rental property directly. First, it typically requires a lot of cash up front, from the down payment to the maintenance required. You really need to assess whether your return on investment will be worth it. The second major downside of real estate is dealing with tenants. You'll need to screen renters before letting them move in. You're also bound to hear sob stories at one point or another, so you'll have to learn to be firm with renters. If you're the type to easily give in to people, you may be better off letting a property management service oversee your rental properties. Either way, there is ongoing work required. Depending on who you talk to, rental properties can be very lucrative. And if you do the upfront work of finding those hidden gems, you can let the property management service do the rest, and rental properties can be a form of semi-passive income. Method number 2, rent a portion of your existing home. If you aren't sold on the thought of purchasing a home only to recoup your money little by little, you could first test the waters by renting a portion of your house. Such an arrangement can substantially decrease housing costs, potentially allowing people to stay in their homes as they continue to benefit from price appreciation on their property. This can be particularly meaningful to older people. According to one report, a quarter of people 65 and older who lived alone in 2021 spent more than half of their income on housing. That figure dropped to 12.9% for seniors living with roommates. Adding roommates can also make that mortgage payment more attainable for younger people. But if you're not sure you're ready, you could try a site like Airbnb. It's house hacking for the commitment folk. You don't have to take on a long-term tenant. Potential renters are at least somewhat pre-screened by Airbnb, and the company's host guarantee provides protection against damages. Renting out a room feels a lot more accessible than the fancy concept of real estate investing. If you've got a spare room, you can rent it. You have a couple of options to do this. First, you could rent a spare room in your home, or you could rent the basement. If you're yet to purchase your first home and like this idea, you could even buy a duplex and live in one apartment and rent the next. The advantages to renting a portion of your house is that you get to watch your tenant closely. It's less likely that a tenant will try to stiff you for the rent payment when you're in the same household. Renting a portion of your house also gives you the ability to get a feel for what it's like to be a landlord without making such a huge monetary investment. Like all investment decisions, the best real estate investments are the ones that best serve you, the investor. Think about how much time you have, how much capital you're willing to invest, and whether you want to be the one who deals with household issues when they inevitably come up. Method number 3, flipping houses. Flipping homes can be a bit risky, but also extremely rewarding. And since property values are back on the rise, this is a good time to get started flipping homes. Flipping a house is the sum of purchasing homes at their market value, fixing them up, and then selling for a profit. House flipping is for people with significant experience in real estate valuation, marketing, and renovation. House flipping requires capital and the ability to do or oversee repairs as needed. This is the proverbial wild side of real estate investing. Just as day trading is different from buy and hold investors, real estate flippers are distinct from buy and rent landlords. Case in point, real estate flippers often look to profitably sell the undervalued properties they buy in less than 6 months. So, to be a successful flipper, you need to hunt down those bargain homes. The less work you have to do, the better. The ideal flip home would be one that only needs minor cosmetic repairs. You could then make the home look more aesthetically appealing and sell for profit. When you decide to flip homes, you have to prepare yourself for the possibility that the home may not sell fast or for much of a profit. You take a big chance when flipping homes, which is why you have to pay special attention to the home's location, needs, and price. However, if you have the knack for flipping houses, you could find this to be one of the best investments you've ever made. Flippers who are unable to swiftly unload a property may find themselves in trouble because they typically don't keep enough uncommitted cash on hand to pay the mortgage on a property over the long term. This can lead to continued snowballing losses. There is another kind of flipper who makes money by buying reasonably priced properties and adding value by renovating them. This can be a longer-term investment wherein the investor can only afford to take on 1 or 2 properties at a time. Method number 4, REITs. If you think real estate is a great investment but don't want to get quite so hands-on, you could take your real estate investing to the stock market. A real estate investment trust or REIT is best for investors who want portfolio exposure to real estate without a traditional real estate transaction. REITs are one of the easiest ways to invest in real estate because they are easily traded through a brokerage account just like a traditional stock. They can be sold quickly to regain liquidity, offer nice dividend returns, and provide access to high-quality real estate assets without having to actively own or manage any properties yourself. Like regular dividend-paying stocks, REITs are a solid investment for stock market investors who desire regular income. In comparison to the aforementioned types of real estate investment, REITs afford investors entry into non-residential investments such as malls or office buildings that are generally not feasible for individual investors to purchase directly. More importantly, REITs are highly liquid because they are exchange-traded trusts. In other words, you won't need a real estate agent and a title transfer to help you cash out your investment. In practice, REITs are a more formalized version of a real estate investment group. When looking at REITs, investors should distinguish between equity REITs that own buildings and mortgage REITs that provide financing for real estate and dabble in mortgage-backed securities or MBS. Both offer exposure to real estate, but the nature of the exposure is different. An equity REIT is more traditional in that it represents ownership in real estate, whereas the mortgage REITs focus on the income from real estate mortgage financing. There are over 200 different publicly traded REITs to invest in across a wide range of commercial and residential real estate asset classes. Since companies can trade under $10 up to hundreds of dollars per share, investors can purchase as much or as little as desired based on their investment budget. Keep in mind that in order to double your money, it's important you seek out the right REITs in growing industries. If you're strapped for time, investing in REITs is probably the way to go. Method number 5, real estate crowdfunding. Real estate investing platforms are for those who want to join others in investing in a bigger commercial or residential deal. The investment is made via online real estate platforms, which are also known as real estate crowdfunding. This still requires investing capital, although less than what's required to purchase properties outright. If you're familiar with companies such as Prosper and Lending Club, which connect borrowers to investors willing to lend them money for various personal needs, such as a wedding or home renovation, you'll understand online real estate investing. These platforms connect real estate developers to investors who want to finance projects either through debt or equity. Investors hope to receive monthly or quarterly distributions in exchange for taking on a significant amount of risk and paying a fee to the platform. Like many real estate investments, these are speculative and illiquid. You can't easily unload them the way you can trade a stock. The rub is that you need money to make money. Many of these platforms are open only to accredited investors, defined by the Securities and Exchange Commission as people who've earned income of more than $200,000 or $300,000 with a spouse in each of the last 2 years, or have a net worth of $1 million or more, not including a primary residence. Alternatives for those who cannot meet that requirement include Fundrise and Realty Mogul. So folks, this is the end of the video. Let us know in the comments if you want us to make more videos like this. Don't forget to like and share this video if you like it. See you in the next video.